Welcome to ETF Wrap, your weekly digest of the top stories in European ETFs. This week, ETF Stream's inaugural rankings of issuer momentum saw BlackRock snub for top position. Elsewhere, activity on the launch front, with a Europe first and the return of an inactive issuer. And finally, our fund selectors bullish on growth after cutting cash positions. First up, DWS claimed the number one spot in ETF Stream's 2023 Power Rankings after leading on launches and staging a comeback in asset gathering. The German issuer scored highest across activity and theme presence categories after capturing $22.5 billion of inflows last year, a turnaround from $3.8 billion outflows the year before. The issuer also boasted 46 new ETFs over the 12 months, including its Europe First SDG range. Also booking a year of strong relative growth was JP Morgan Asset Management, with the issuer's $5.7 billion of inflows last year further cementing its dominant stake in European active ETFs, where it has a 42.5% market share. Elsewhere, new entrants AXA and InvestLinks made a splash by finishing within the top 20, owing to strong inflows and launch activity. Faring differently, UBS Asset Management and State Street Global Advisors did not make the top 10, with the former suffering outflows and the latter stymied by low launch activity. Next, an interesting week in launches, as Han ETF and Sprott offer a new esoteric exposure, and Goldman Sachs Asset Management announces its first launch since 2022. Han and Sprott's fourth partnership marks Europe's first junior uranium miners ETF. The new product captures small and mid-cap miners, which are more exposed to the price of uranium and less exposed on the contract front. Elsewhere, GSAM has expanded its ESG fixed income range with a global green bond ETF. The product captures green bond issuance from companies in G10 countries and marks the firm's first launch since its Paris-aligned global equity ETF. And finally, the latest Bank of America Fund Manager survey revealed cash positions have been cut from 4.8% to 4.2% as investors go all in on US tech in anticipation of interest rate cuts. In fact, 61% of respondents view US mega-cap tech as the most crowded trade, with 85% expecting the US Treasury yield curve to steepen in the coming months. Interestingly, these findings came despite recent inflation readings and most managers predicting no recession on the horizon for the first time since April 2022. And that's a wrap for this week. Thanks for joining us, and remember to hit subscribe to keep up to date with all the latest in ETFs. Until next Friday, take care.